Hi, and welcome to this chapter, Candle Retracements. After learning how to identify the candles themselves, there are two techniques on how to trade the candle signal on the chart. One way of doing it is an immediate entry, another way is the retracement entry rule. As the name itself, immediate entry is as soon as you see the candle close, all the candles learned in the previous chapters, be that a 1 hour, 4 hour, daily, or whatever time frame you're trading on. It really doesn't matter. What matters is the candle must first close, and then the second it closes, you must enter that trade immediately, following the immediate entry rule, often requiring a slightly wider stop loss. The second is the entry retracement rule. We allow the candles to close, and then we wait for the retracement of those closed candles. Think of it as a discount you received. If you get a 50% retracement on the previously closed candle, you're essentially risking less per trade. Your stop loss can be the same place as where you put your stop loss in the immediate entry rule, for example, but you received a better price for it. It may be hard to understand, but it's the same way as receiving a discount at a clothing store. So let's show you on the chart on what we mean by this. So just by looking at this chart, we can see various different types of entry rules. We'll highlight all the ones we can see and the ones that you can actually use on. So let's first jump into identifying these quickly, and then we can move from there. Here's another one here, and another one here. Okay, there's also another one here, and another one here. It's actually two here. Alright, so, and another one here actually. Let's go down in order of actual trend. So here we can see a bearish engulf. Let's try to zoom in on this so we can see it better. Here we have a bearish engulf. Now, on an immediate entry rule, you'd enter on the close of this candle. But with a retracement entry rule, you wait for a 50% retrace of the body of the actual closed candle. So the bearish engulfing pattern formed here, as you can see. Let's just make this a lot smaller so it's seeable. There, like that. The close of the candle was bearish engulf. That over here was a retracement rule of 50%, and then ideally it fell like it did. So we got discount. So we'd have placed our entry not on an actual immediate entry rule here. That would have been our entry, and that would have been our stop loss. Now with a 50% entry rule, you get a retracement, and then your entry would now be over here. Your entry would now be over here, with your stop loss at the same position as before. You see the difference of this two here gives you a pip difference of 20 pips. So essentially you got a 20 pip discount on that amount. So you can risk either slightly more to offset the same amount that you're willing to risk on your stop loss, because your distance is closer to your stop loss. Do you guys understand that? So in essence, our entry is later, but you get a discount on the actual entry. So that's the difference between the two. Let's now go to example here where there was no retrace. So our entry would have been immediately there. Now must remember, guys, you don't actually know if you're going to get a retracement or not. Sometimes you get the retracement. This is where the currency strength meter comes in. So let's say this is USD Swiss franc. The Swiss franc has to be a bit stronger to get a longer retrace here. It didn't. The dollar was very strong, and it pushed it up immediately. You have to know this according to your currency strength meter. Remember, this is just the now currency strength meter. The price strength currently is now, not over a 1 month, a 1 week, a daily, a 4 hour, 1 hour. It doesn't work that way. This is purely over the immediate strength now. So on this, we'd actually have to see that the dollar is still very strong. We did get some sort of retracement there. It's probably like a 23.6 retracement, but then it shot up again. Okay, on this, ideally, it literally is luck of the draw when it comes to retracements. Sometimes you wait for the retracements and it doesn't happen. then you're not in the trade. Then your risk reward's even worse than it would before if you had an immediate entry. So ideally, sometimes it's just best to get in immediately, and then trade might first go against you, and then go for you. Must remember, guys, your trades are not always going to profit immediately. Trading doesn't work that way. We've had one or two clients before one client asked us saying, my trades aren't going to immediate profits. Like, he says, I have to wait like 2 days and then it goes into profit. Like, it's just common sense, okay? You guys must understand that your trades are not going to run into profit immediately. It does not work that way. Sometimes you might have in a trade for 3-4 weeks before it goes into your desired direction. Okay, it's just the way trading is. So the sooner you accept that, the easier and quicker you'll learn. So going back to the entries, this would be an immediate entry with our stop loss below. There was no retracement, so essentially this trade would have had to be entered immediately. Whereas this trade here was a morning star. Must remember, guys, like we said to you, a morning star can consist of 3 or more candles. Here's an example of that. Is that it's a U shape. You're looking at the structure, not the numbers of candles. It's a structure. So for that now, that's a morning star. Sorry, evening star. And we have the retracement. So you could either have entered immediately on the close of the morning star. Great. Or you could have entered where? On the 50% retracement of the body of the last candle in the morning star. So then your stop loss would have been above the high. So now essentially you would have got a discounted rate, the retracement, and then the fall. You could have entered, like we said, at immediately, but the trade would have first gone against you and then gone for you. So that's still fine. There's no problem with that. It's just obviously you can see your entry would be here and your stop loss would be the same place, but it's wider. It is, okay, that's 95 pips, so let's just place this here, 50%. You'll be risking 65 pips on a late entry or a retracement entry, and you'll be risking 95 pips on a immediate entry. Okay, you must remember, the closer your entry is, well, the better the 50% discount that you get. That means you can slightly risk slightly more, but risking the same as what your entry on a immediate entry would be. Now let's move over to the next examples. As you can see here, there's a morning star, another 4 structured morning star, sorry, evening star. Then we have the evening star. It's a 4 structured one, 4 candles, even 5 maybe if you want. But this would be an entry there. We did have a slight retracement, but I would have totally taken the immediate entry. The longer the body, the bigger the chances of immediate entry. Okay, so the closer your actual body closes to the wick, or if there is no wick, the better, the stronger the candle is. So obviously our stop would have been above the high, and then obviously the trade would have continued down. Let's now move over down to the low examples. So here we have another morning star. As you can see, 3 structured morning star. Do we have a retracement here? This trade would have been a tricky one, right? You can either put a buy stop order here, well, like we said to you in the orders, but in the previous chapters. But this trade would have first gone up and then come back down. Sometimes that happens. It's just part of trading. Okay, so we would have got our entry and then carried on. So instead of entering at the top here, we now entered at the slightly 50% discounted rate with our stops below, which is great for us. So now we can go on to the next one, which is also, we can call this a bearish engulf. Okay, so this bearish engulf, it's 1, 2, 3, 4, 5, 6, 7, 8 candles. That shows us that this actual candle has a lot of actual strength in it. We had the slight retracement. It's more or less 50% of the actual body, which is correct. But now, this is where it starts getting tricky. We had the drop, and then it rose back up. Where would our stop loss have been? Above the high. With that there. Now, even though we entered on the 50% retrace, the trade would have gone for us first, and then gone against us, and then gone for us. Alright, so this is where patience is required, guys. You have to understand that even if you enter the trade here on an immediate close of that bearish engulf, our trade stop loss would be 150 pips, and ideally that would, the risk to reward values wouldn't have played out so great. So a 50% entry rule is better, because you can see now we're probably risking maybe 100 pips. Yeah, 100 pips to get a return of 250, or 1 to 2, minimum 1 to 2 risk reward would be down here, and that trade would have been success. So you got to understand that obviously sometimes it might fall for you immediately, sometimes it retraces, sometimes you wait 5, 6 days, 7 days, and then all of a sudden, boom, goes all the way down. Okay. And then we move on to our hammer rule. As you can see, there's a massive hammer here. Now for a hammer, I always like to wait for 50% retracement of the hammer. So either I'd like to see the candles that opens after the hammer retrace 50% into the wick itself, and then ideally I'd like to see the buy opportunity. For me, on a hammer, I don't enter immediately. I never do. I always wait for the retracement of the wick. So my entry would have only been down here at 50% retracement of the wick. Okay, so while it's going bearish, I would have been in the buy, because this is a major support or demand zone. Okay, so in itself is a daily structure there of a double bottom, and another double bottom on here. This would be a nice 4-hour double bottom, and then you'll obviously see the buy. So you could either have waited for this here. Let's get this out of the way quickly. This morning star to happen, this 3 structured morning star as well, with a slight retracement there. I mean, okay, if you place your order here roughly 50%, okay, you've got to keep an eye on the price itself. Now you'll often see that say this is a Tuesday candle, the Wednesday has a slight retracement coming into Asia, and then at London open, price will start to move onwards. So moving into London session is when the actual market liquidity kicks in. So Asia would always be maybe a slight retracement and then kick off. Okay, this is why it's important to look at the larger price structure of the daily, weekly, monthly. So that would be obviously the morning star, the slight retracement and entry we could look to buy. So obviously, if we've got a double bottom pattern, we're looking for trend continuation, or sorry, trend reversal into a trend continuation, which is the upside, which we were getting. Now obviously we're looking for, this is short-term trades between here, guys. So look, if you look here, you can see there's lots of hammers, right? Inverted hammers. There's one, there's one, there's one, there's one, there's one, there's one here. But you must remember that we've got to consider our wave counts. A trend is not completed till a wave count is completed. So there is a possibility of a lot of short-term trades here, but they are short-term trades. They're retracement trades on the daily trend. You might be targeting 80 pips, but in the larger perspective of this move, it's actually an uptrend. So you've got to keep in mind that wave count is also important off your reversal patterns, and then continue that trend till the wave count is finished. Okay, so here's the last example of where prices currently. We had a major inverted hammer. We had the actual retracement rule. Yes, I myself entered yesterday over here. So now we are waiting for ideally for the next drop, with our stops above the high. So for me, I'm risking 60 pips, if I remember was correctly. I'm looking for 1 to 2 risk reward. So it means I'm aiming for 120 pips to the downside. Okay, that's just because this pair is due retracement. In the 4 hour, it's also got divergence, but we'll get into that also obviously later in the course. But as I said, these retracement rules is probably the better. It's the better signal. It's the better entry rule. It just gives you a discounted rate and allows you to have greater profits while trading, allow you to trade a higher lot size. Cool, guys. With that, you can move on to the next chapter.